Welcome to the webinar on accounting standards for small and medium companies, organized by Regional Council and Chapters Coordination Committee, jointly with Corporate Laws Committee. So before we proceed towards Anthem of the Institute, I just want to introduce initially who are with us. We are having with us our Vice President, sir, CMAP Raju Iyer, sir. Sir, good evening. We are having Dr. Murthy, sir, Dr. KCH Aviation Murthy, Chairman of the Regional Committee also. We are having CMA Dr. Ashish P. Thate, sir, from the Corporate Laws Committee, and we are having very resourceful person, our speaker today, CMA Guru Raj Acharya, sir. A very good evening, sir.
Good evening.
So, I am just requesting to play the national anthem of the Institute.
Asato ma sadgamaya tamaso ma jyotirgamaya mrityurmamritangamaya
Asato ma sadgamaya tamaso ma jyotirgamaya mrityurmamritam gamaya.
Asato ma sadgamaya.
Now I will request Dr. Murthy, sir, to give his welcome address, please.
A very, very good evening to all of you. Mr. Vice President Raju Iyer hails from Chennai. My friend in the council, Ashish Thate, who hails from Bombay. And today's hero and speaker, Guru Raj Acharya, who hails from Bangalore. Sumita Chakravarti Madam, and dear colleagues of the council and dear cost accountants. Let me wish all of you happy Guru Purnima. Some people are telling today, some people are telling tomorrow. Anyhow, it is best wishes to you on my personal behalf and on behalf of the committee and institute to all of you. We'll start with the message by our beloved Vice President. May I request on behalf of all of you, Mr. Raju Iyer, to address us.
Thank you, sir. Respected our Chairman, CMA, CHAVNS Murthy, Chairman for RCCC and the General Committee, and CMA Assistant Chairman for Corporate Law Committee, and our eminent resource person, CMA Guru Raj Acharya ji, and our Director Dr. Sumita Chakravarti ji, and Sanjay Guji, and other members and participants. It's a topic is excellent topic, and it is giving us a very good opportunity. We have many members, many people doesn't know what are the things for the small and medium scale entities, what law and what the acts are applicable to them, what standards are applicable to them. This will be in depth dealt by our eminent speaker today. And as a cost accountant, you are having very good scope with the MSME, and we have celebrated 2 months before MSME month, where the lot of MSMEs and MSME association highlighted that what are the issues they are facing, what are the things they are having, and all the things. And in fact, we are having lot of help desks for MSMEs also. And this is also giving you an excellent opportunity to advise MSMEs, whatever applicable to them, whatever not applicable to them, what is more important. This will be highlighted by eminent speaker. I am also very eager to listen to our eminent speaker. So today will be a very excellent day for all of us. And as Chairman has said, it's a Guru Purnima day. We will respect our Gurus and pranams to all the Gurus. We will take care of our health, wealth, and all aspects, and let us have a peaceful days ahead. I am wishing the program a grand success, and really it will be a value-adding session. Mr. Guru Raj Acharya is a very eminent speaker, and he addressed a lot of our programs and all the things. Though he is from Bangalore, he has addressed all India level, and today we are having a lot of participations also, and we will have a session more interesting. Please ask all the questions, whatever doubts you are having, so that we will be able to advise the MSMEs accordingly. Because now MSMEs are looking for a lot of suggestion advice in this pandemic situation. We hope you will have able to get real value. Thank you very much for the opportunity. Wishing everyone happy and healthy days. Good day, good day, good day. Thank you.
Thank you, Mr. Vice President. Thank you for your best wishes. And as right after the review, this is a good program for all the cost accountants. Thank you. I also request, though it is not a program, Mr. Ashish Thatte, to say a few words beginning.
So thank you, Dr. Murthy sir. Good evening to all of you. Respected, beloved Vice President of the Institute, Raju Iyer sir. Dr. Murthy sir, who is the Chairman of Regional Council and Chapter Coordination Committee. My colleagues in the Institute, that is Vibhu Madam, who is joining from Corporate Law Committee, Sumita Madam from the RCC and other IT committee. And the most important person today who has joined is the Gururaj Acharya sir, who is the cost accountant and will be speaking on today's topic for the cost accounting standard for the MSMEs. Yes, as what both of earlier speaker has stated, that today is Guru Purnima and we got the opportunity to listen about the topic from a guru also. So it's a really a very good day which we have caught upon. So thank you to our gurus, all gurus, and today's our guru is Dr. CMA Gururaj Acharya sir. Welcome to you to our webinar. And I must say that we all last so many days we have seen pandemic almost is 1.5 year, rather a year and 1 quarter and few months also has gone past. We have seen pandemic, we have seen difficult days, and with these difficult days, we have come out with a very good kind of a model of working, and that is from the institute side is the online offline kind of a model. And last 1.5 year, I think the number of programs which has been arranged by the institutes, various organs, headquarters, regional council, chapters, etc., are phenomenal. I mean, I haven't seen in my life that this much of programs and the knowledge distribution, which has not happened for the number of years. If you all together the programs which has happened in last few years, you just cannot compare that with what we have done in last 1 year. So it is all about us as the member student to take that knowledge. And that is where today's Guru Purnima is very important, that we should have a guru who should be able to tell us that what is to be learned. And there are so many things to learn. There are n number of things to learn. There is no end to learn. Possibly what we were supposed to do 10 years, 20 years down the line, we have done it right now in last 1 year. So with this note, my best wishes to the program. I will be interacting with you at the end of the session once again for the questions, summing up, etc. So I don't want to stand much in between you and the knowledge sharing on this auspicious day of Guru Purnima. So welcome you all for this session, and over to you, Sumita Madam. Over to you, Murthy sir. Thank you so much.
Thank you, Mr. Ashish Thatte. Though this is, I hope Corona is gone. I wish it will gone. We will not recall this one past, but that this one past has given a good decision, good lessons to all of us to be more careful about health and more careful also about our online everything. Hope everything will be all right. This good Purnima will solve all the problems of Corona in the entire world. I wish. And thank you, Mr. Ashish Thatte. Sir, when I went to many classes to teach accounting standards, many of the participants, I asked them already one question. Kindly take your white paper and pen, write on the right side, top, 3 zeros. Believe me, somebody wrote horizontally, somebody wrote vertically, somebody wrote in all directions whatever they like. Somebody did not write us. For a small English question of writing 3 zeros on the left side of the top white paper has given me many answers which I could not solve. Means what exact I feel is flowers speak love and affection, clothing speak about gentleman dress. Similarly, our accounts speak of the accounts is language of the business. So since we are talking about WTO, World Trade Organization, according to me, I always define WTO as world of threat and opportunity. It's about no doubt trade organization, but threat, where is threat? I will not go. Opportunity I will go. So in this WTO, we should have a common language. All stakeholders in the world should know what exactly the financial statements speak. Probably that is need for having a standards. I worked in the, thanks to my president and my council members, I've been a chance to work in the CA Institute Accounts Board. I know how difficult it is to prepare a standard. It takes the minimum 3 to 4 years by the time it comes out, and then all implications. And secondly, we should have a proper comparison and public interest is to be protected. Take universal application is the thing. Worldwide acceptance of the statements through with the help of the accounting standards. Keeping the importance of these things, recently they have given circular 388 pages, circular on 23rd 6th. It talks about again all standards to be applicable to SMEs, and we have got around 13 lakhs companies, 13.7 lakhs companies in the country which are operational. Totally 22 lakhs are incorporated so far. 13 are very much operational, and these most of them are small companies. For all these companies, these standards will be applicable. And doing business, one of the criteria is these accounting standards and everything. So, in this background, we have invited, since being this a contemporary topic for the cost accountants, I and my colleague have planned to do a seminar on this, and we have drawn the right subject, a right speaker, none else, Mr. Gururaj Acharya, who hails from Bangalore. Friends, he hails from Temple Town, brought up in Iron City, and later came to Northern City, that is Bangalore. Mr. Gururaj is a qualified chartered accountant. He is also a qualified cost accountant. He is practicing as CA in Bangalore now. He is a rank holder in BCom. CA also he has got rank. And in our own exams of CMA, he is inter first rank holder and final third rank holder. A very good choice rather by me and my other committee, Mr. Tate, to draw you up. And Mr. Gururaj Acharya, every day he addresses the chartered accountants. And today it is done of CMAs. Known to me in all southern parts of the country, every day he addresses in the evening 5 to 8. You will not find him today except in our virtual room. He is talking about all accounting standards. And he is a member of Bangalore Financial Reporting Review Group, formulated by the FRB Board of CA Institute. And he was director on the Board of Directors of the State Bank of Mysore. And he was member of the Karnataka State Level Audit Advisory Board. And he was co-opted member of the Expert Advisory Committee of Accounting Standards for Local Bodies by our CA Institute. And he authored also some books, Internal Financial Control, Practical Handbook on Audit Report, and What Can Go Wrong. This is most important. And it is published by Karnataka State CA Association. And he is resource person to us on accounting standards in auditing, Companies Act 2013, LLPs, corporate finance, financial analyst, corporate taxes, and tax act. On this good occasion, whom do we need except Gururaj to talk about the standards? And I thank my both the council members. May I request Gururaj sir to enlighten us, enrich us on this day, especially about the standards applicable to SMEs. For Mr. Gururaj.
Good evening to all the learned members of the profession. At the outset, let us remember all our gurus who have brought us to this stage. So, Shri Guru Bhyo Namaha. And Tamasoma Jyotirgamaya is a very beautiful caption of our institute. I thoroughly respect all the senior members of the profession who have named or coined this particular Tamasoma Jyotirgamaya. I think if we are able to light the knowledge through our knowledge, if we can share, that's the best service that we can do for all our gurus. So having said that, I remember, although Murthy Garu called me maybe 20 days back, to talk about this particular subject, he was very forceful that I should restrict myself to small and medium companies. Thank you so much, sir, for reminding me about that. And I told him one thing, that 1 hour is very small for talking about all the standards. He said, you better give an introduction. If we need something more, we'll always come back to you. Yesterday, for example, in Guntur, when I was addressing, for 4 standards, I took 3 hours. I mean, one can go deeper or one can go wider. But then today I will be restricting myself to the wider aspects of the topic and also take up as many issues as possible from the audience. So I request the audience to be participative in this particular session. Any questions that they have, I request you to feel free and post it in the question and answer box. I'm so honored to be in the midst of the learned Vice President of ICMA Institute, Raju Iyer sir, Thank you so much. Your presence really adds glamour to this particular session. Just as the Corporate Loss Committee Chairman Ashish Titteji from Bombay. And the best thing about this pandemic, sir, is that I'm able to address 3 sessions in a day. And I'm sure that is a situation with all of you because we have all come to the virtual platform. I remember the toughness of the ICAA Institute. 4 days, 8 paper. CA Institute examination was easy for me. ICAA paper was really tough. 4 days, 8 paper was not only a test of the mental strength, it was a test of the physical stamina also. In fact, these days the children are lucky. In CA Institute, for 2 days they have 1 paper.
Yes.
For 2 days they have 1 paper, whereas we were in, I don't know to call as good times or bad times, we had to give in 1 day 2 paper. And maybe that particular examination has prepared us to face bigger difficulties in life. Bigger difficulties in life looks very small when you have prepared for such a tough examination in the younger days. So I really respect and admire and adore the Institute of Cost Accountants of India, which has really given me the base for being successful in life. I admire and respect all the founders of the Institute. Coming to my topic in particular, Dr. Sumita Chakravarti ji, thank you for so much. And I request you to, you are sitting out of Calcutta, Calcutta, Bangalore, Hyderabad, Bombay, so beautiful, in one platform. It was not possible at all. And substance over form is truly this. Otherwise, we would have spent so much of time in the forms and formalities, because accounting standard is all about substance over form. I think this is exactly a situation where we are coming to understand the real meaning of substance over form. Having said that, when I was a student of accounting and reading in ICMA, the only standard that we were talking about is international accounting standards. When we were students, we were referring to international accounting standards. Now, if I have to ask one question, whether international accounting standards is still relevant, the answer to that is international accounting standards has been overtaken by international financial reporting standards. Now, the question that I immediately ask is, what is the difference between international accounting standards and international financial reporting standards? The answer is very similar to what is the difference between Calcutta and Kolkata. What is the difference between Madras and Chennai?
Very nice.
There is no difference. So just that they renamed the international accounting standards to international financial reporting standards. So international accounting standards was there up to 2000, and after 2000, the same literature, they called it as international financial reporting standards. Now the question is, why did they change it from Calcutta to Kolkata? Maybe we wanted to have a native name. We wanted to have our own name. Chennai was the original name. When the Britishers came to India, they converted it into Madras because they could not pronounce it better. So therefore, we wanted, after independence, we wanted to get back our original name. That is why Madras was called as Chennai. But then if you ask, why was accounting standards, international accounting standards, changed to international financial reporting standards? This has got nothing to do with the Britishers. Although International Accounting Standards and International Financial Reporting Accounting Standards Board is situated in UK, it is situated in UK. What was the reason for accounting to be substituted with financial reporting? Why was accounting called as financial reporting? The reason is whatever comes in accounting will finally find a place in the end product, which is financial reporting. Now, all of us have to understand accounts is a basic books of accounts which will collect all the day-to-day transaction and the periodic information, and finally all of them will find its place in the final financial report that is called the financial statement or the financial report. So accounting was a raw material and financial reporting was a finished product. So the preparers of the accounting standards in the Accounting Standards Board, they felt that if they are able to control the finished product, the work in progress and the raw material is automatically controlled. Whereas if it is controlling only the raw material, probably the work in progress and finished products is not controlled. The word accounting was only restrictive, whereas financial reporting was a larger picture. So they changed the name from accounting standards to financial reporting standards. So that was the reason why they changed from international accounting standards to international financial reporting standards. Now, why did I talk about international financial reporting standards? In India, if you ask how many accounting standards are there, interestingly, there are three sets of accounting standards. There is something called the Ind AS, something called the accounting standards for companies, and accounting standards for non-companies. So for companies, we have got two sets of standards, Ind AS and companies accounting standard rules. And for non-companies, we have accounting standards of the Institute of Chartered Accountants of India. So today I'm not talking about the accounting standards for non-companies. I'm talking about accounting standard for companies. Now for companies, we have got, depending on what type of a company you are, a different type of standard will be applicable to you. If you are a class company, if you are a big company, a large company, Ind AS is applicable. For other than the class company, accounting standards as told under the company's accounting standard rules will be applicable. So what is Ind AS? To whom does Ind AS apply? What is Ind AS? Ind AS is a cousin brother of IFRS. I mean, it is we have adopted IFRS. Instead of calling it as adoption of IFRS, we have customized our IFRS. To the Indian requirement and called it as Indian accounting standards. In short, called it as Ind AS. Now, whom does Ind AS apply to? It applies to all listed companies and all companies, even if it is a private limited company, if such a company's net worth happens to be more than 250 crores. And if you are an NBFC, company, whether or not you are listed, whether or not your net worth is more than 250 crores, Ind AS will be applicable. Today, I'm not going to talk about Ind AS. What am I talking about? I'm going to talk about accounting standards as applicable to other than Ind AS companies. Now, who are these other than Ind AS companies? Companies which are not listed, companies whose net worth is less than 250 crores, and companies which are not in the field of non-banking financial services. So these are the three types of companies to which Ind AS will apply, and not only to them, but all other companies which are an associate, joint venture, holding, or a subsidiary of such a company will also have to prepare under Ind AS. Now, what is the reason that they have to prepare under Ind AS, although they are not big? Just because they are associated with a big company, as a holding company, subsidiary company, associate, joint venture, or an investing company. So they also have to prepare under Ind AS for the reason that finally all of them has to be consolidated. And if the holding company is Ind AS, subsidiary company also has to be Ind AS, because all of them have to come on a single balance sheet level when they prepare the consolidated financial statement. So we completed about Ind AS. Now we will talk about the regular company's accounting standard as applicable to other companies. So for which now I am putting up my presentation. I will put up my presentation and then you will see what are all the various standards that are there. Yeah. Dr. Chakravarti, can you just confirm that you are able to see the screen, madam?
Yes, sir. It is visible.
Thank you so much. This is I have an 18 slides presentation for the next 1 hour, and I will stop at 7:20 and maybe around that time. But I would answer all the questions that is posed by the audience. So please ensure that you ask as many questions, because we don't grow just by listening, but we grow by questioning and getting our issues solved. Most of you might be already knowing what I'm going to talk, but then I'm going to talk only just to set up, set a stage. But after that, all your questions I would like to listen and answer it accordingly. So Murthy Garu went on to say, the company's accounting standard rules has come out with 388 pages. That was a 388-page notification which came on 23rd of June 2021. Until this notification came, this is called the Company's Accounting Standard Rules 2021. Until this notification came, we used to follow Company's Accounting Standard Rules 2006. We had 2006. Now, why did this notification come? All of you are aware that the Companies Act was formed the Companies Act is Companies Act 2013. But all the accounting standards that has to be followed by a company were there in the 1956 Act, in the 1956 Act under the Companies Accounting Standard Rules 2006. And in 2013 Act, the Companies Accounts Rules, Rule 7 specifically went on to say, until such time our Act comes out with its own rules of accounting standards, we have to follow the accounting standards as told under the 1956 Act, which means Companies Accounting Standard Rules 2006. So right now, until financial year 2021, because Companies Accounting Standard Rules 2021 is going to be applicable from the current year, 1st April 21. Up to 31/3/21, the financial statements which are prepared will be prepared by the companies which are not following the Ind AS using the Companies Accounting Standard Rules 2006. Now, on 23rd of June, they substituted the 2006 standards with 2021. The first question is, are there any changes between 2006 rules and 2021 rules? Substantively, there have been no changes. Let me tell you, all the words which are there in 2006 has been verbatim reproduced in Companies Accounting Standard Rules 2021. So if you're already used to what is 2006 rules, the same thing needs to be continued. But there has been one important change which has happened both in 2006 and 2021. They have given some liberalized provision to a small and medium company. That is a topic. Our topic today is to talk about accounting standard for small and medium companies. For very large companies, Ind AS. For large companies, all accounting standards will be applicable as told under the Companies Accounting Standard Rules 2006 or 2021. But for small and medium companies, there are certain standards which are given a relaxation. There are relaxations given to small and medium companies. So before we go to see what are all those relaxations that are applicable to small and medium companies, let us understand what is a criteria for calling a company as a small and medium company. Now, in 2006, the criteria was like this: whose equity or debt securities are not listed. If the entity is not listed in any stock exchange, or it is not a bank, not a financial institution, or an insurance company, and whose turnover is less than 50 crores, excluding other income, if their turnover is less than 50 crores in the immediate preceding accounting year. That means if I am looking into 2021, whether it is a SMC, I will look into the turnover of 1920. If the turnover was lower than 50 crores, then I will say you are an SMC. Not only that, I will also go into what is your borrowing. Is your borrowing less than 10 crores? Your turnover should be less than 50 crores. Your borrowings, including public deposit, should be less than 10 crores. And it should not be a listed company, not a bank, not a financial institution, not an insurance company. And such a company should not be the holding or a subsidiary of a company which is not a SMC. So that was the definition in 2006 rules. In 2021, they slightly changed the definition or the criteria. Instead of turnover of 50 crores, they increased it. All of you might be aware that MSME definition for large entities. There is a micro, small, and medium enterprise, and then there is a large. Earlier, the definition of a large entity is anybody's turnover was more than 50 crores was considered to be large. On 1st of April 2020, they increased the turnover from 50 crores to 250 crores. So what they did was they brought it in line with the MSMED Act. So 250 crores. If your turnover is more than 250 crores, only then you will be considered as large. Otherwise, you will be considered as a small and medium company. And the borrowing also should be less than 50 crores. That is the revised criteria as applicable from 1/4/2021. So please understand, for 2021, the financial statements which is under preparation and which is under audit, the criteria for turnover is 50 crores and borrowing is 10 crores. Let me give you a small example. If my turnover was 40 crores and my borrowing was 12 crores in 1920, then any one of the criteria breaching, I will not be a small and medium company. Because my turnover was 40, I was within 50, but my borrowing was more than 10. Therefore, I cease to be a SMC. All the criteria should be complied to for me to be called as a small and medium company. Now, once I am a small and medium company, I can get certain relaxation. I will tell you what the relaxations are in the next slide. But before that, if I choose to take all those relaxations in the financial statements, I have to come out with this particular note in the notes to accounts saying that the company is a small and medium company as defined in the general instructions in respect of accounting standards specified under section 133 of the Companies Act 2013, read with rule number 7 of the Companies Accounts Rules 2014. Accordingly, the company has complied with the accounting standards as applicable to an SMC. So if I am an SMC, considering this criteria, and I choose to take the relaxations available to me, then I have to give this particular note. Now, before I go to see what are all the relaxations available to an SMC, let me put up the full list of all the accounting standards that are applicable to a regular company, not to an SMC. I'm telling regular company. So there is a class company to whom Ind AS is applicable. Then there is a regular company. Then there is a SMC company. To an SMC company, there are certain relaxations, but to a regular company by definition means not a listed company, not a company with a net worth of 250 crores. Then it will be a regular company. To a regular company to whom Ind AS is not applicable, there are 29 accounting standards. I mean, I'm aware that there are 4 cost audit standards that are applicable, but just like that, we have in the list 29 accounting standards that are applicable to a regular company, which is not an SMC. I may call it as a non-SMC. To a non-SMC and to a company to whom Ind AS does not apply, there are 29 accounting standards by numbers. But if you see, accounting standard 6 and accounting standard 8 has been struck off, which means they are not there in the accounting standard literature. So today, although there are 29 by numbers, we have got effectively only 27 accounting standards. So as I'm talking, let me explain you each one of these standards in brief. Then I will concentrate on what is the standards that are applicable to SMCs, and then I will go to the issues in each standards. What are the problems problem areas in each accounting standards? Then I will open it up for question and answer. So that is the session of the day. Accounting standard 1 deals with disclosure and accounting policies. Disclosure of accounting policies. Now, all of us are aware that there could be various. Accounting is not a perfect science. All of us are aware it is not a perfect science. Without the standard, each person could have done it in his own way. So to reduce the various options available to the preparers of the financial standards, financial accounts, we have standards. And out of the various options, they have reduced it. In the accounting standards, you will find that there are still 1 or 2 options available to you. 1, 2, or 3 options available to you. For example, when we talk about depreciation, we can use the return on value method of depreciation, the straight line method of depreciation, or the unit of measure depreciation. Okay. Similarly, when it comes to the inventory valuation, the fundamental rule for inventory valuation is cost or net realizable value, whichever is lower, or lower of cost and net realizable value. And for the purpose of determining cost, we can either follow the weighted average method or the first in, first out method. We cannot follow the simple average method or any other last in, first out method. We cannot follow that for valuation of inventories for accounting purposes. Having said that, in the disclosure of accounting policy, I will have to spell out of the various options available to me, when I am doing certain important calculation, which is the option that I have selected. Out of the permitted option, I cannot choose from the not permitted option. From the permitted option, which option did I select in the preparing of the financial statements for this particular year? What is my policy? For example, I will say depreciation on property, plant and equipment has been prepared using the straight line method of depreciation as per the rates given in the Companies Act Schedule 2. So I will say that. For the purpose of inventory valuation, the inventories have been valued using cost and lower of cost and net realizable value. For the purpose of cost, I have used weighted average method of accounting. So I will have to tell out of the various options which option I have selected. That is disclosure of accounting policies. And then how do you select an accounting policy is also told. I mean, when you are selecting accounting policy, you shall give cognizance to materiality, prudence, and substance or form. And the standard also goes on to say that all accounting policies should be disclosed in one place. And this disclosure of accounting policy says you shall disclose not all your accounting policies, but only those accounting policies which are significant to your financial statements. Like that, there are certain rules told. That is what is Accounting Standard 1, disclosure of accounting policies. Now, Accounting Standard 2 is valuation of inventory. As I already told, inventories could be valued at, as a principle, the inventory should be valued using cost and net realizable value, whichever is lower. For the purpose of cost, I can choose only weighted average or FIFO method of valuation if the goods are interchangeable. However, if the goods are not interchangeable, then I shall follow specific identification method of costing. I should take the specific method. All of you are cost accountants. I don't have to tell you what is specific identification method. Now, what it means is, if there are 10 items which I have bought, if the items are interchangeable, then the first 6 items which have gone out are pertaining to the first 6 invoices of purchases, and the last 4 is out of the last 4 invoices. But specific identification method means, if I have bought 10 items and I have sold item number 1, item number 7, item number 8, 9, 10, 1, 7, 8, 9, 10, 5 items I have sold, then the items which are in stock pertains to item number 2, 3, 4, and 5. That is the invoice number which is pertaining to. So I will specifically find out this particular item belongs to that particular invoice. So my inventory will be valued based on that particular invoice. So specific identification method is the primary method used in case the inventories are not interchangeable, But if the inventories are interchangeable, then I have to follow FIFO method or weighted average method. Between FIFO and weighted average, I can use the technique of retail cost method, or I can also use the standard costing method when I'm doing the valuation of inventories under Accounting Standard 2. Now, coming through Accounting Standard 3, cash flow statement. Today, general purpose financial statements as defined under the Companies Act means balance sheet, profit and loss account, cash flow statement and explanatory notes to the accounts. So these 4 become the financial statements. So cash flow statement is also important financial statement. How a cash flow statement has to be prepared is what is told in Accounting Standard 3. I am not talking about the details of a cash flow statement today, because if you see what is given in blue here, what is given in dark blue, especially Accounting Standard 3 and Accounting Standard 17 on segment reporting, if you come down and see, it is not applicable to small and medium companies. So since I am not talking about all accounting standards, I am talking about only those accounting standards which are applicable to small and medium companies, I may be permitted not to talk about cash flow statement and segment reporting. Although in brief, I will tell you, cash flow statement brings in cash inflows and cash outflows under 3 specific headings: from operating activity, from investment activity, and from financing activity. The entire inflows and outflows are segregated between operating activity, that is a normal operations, investment activity, that means I have invested in fixed assets or property, plant and equipment, or some other investments, or financing activity. Financing activity means how the monies have come in either by way of debt or by way of capital, or repayments of that is an outflow on account of financing activity. So cash flow statement under 3 different headings. It can be prepared under the direct method or under the indirect method. I am not talking about that today. Accounting Standard 4. If you see in this entire chart how I have prepared is, although it is a full list, if something has been given in bold, like for example, disclosure of accounting policy and valuation of inventories, revenue recognition, property, plant and equipment, they're all given in bold. That means these are the most applied accounting standards in an SMC. In an SMC, we see that these are the standards which are most applied. So I will spend more time in those standards rather than in every standard. Although there are 27 standards today, what is most relevant is what we will concentrate on. But Accounting Standard 4, contingencies and events occurring after the balance sheet date, means even if, although the balance sheet cutoff date is 31st of March, if there are certain events which have happened after 31st of March, this standard says some events should be disclosed even though it has happened after the balance sheet date, and some events, if it affects the going concern of the enterprise, then such an event needs to be recognized in the books of accounts. Contingencies today have been moved from accounting standard 4 to accounting standard 29, and still only contingencies means provision for bad and doubtful debts is still covered under accounting standard 4. Accounting standard 5 is net profit or loss for the period, prior period items, and changes in accounting policy. So this standard goes on, not very popular standards. That is why I've kept it in just a small print there. So net profit or loss for the period. That means every item of revenue and expenditure, unless it is a capital receipt or a capital expenditure, must be routed through the profit and loss account. You cannot take a particular income directly and to the balance sheet under reserves and surplus. So accounting standard 5 tells that every item of profit every item of revenue and expenditure should necessarily be routed through the profit and loss account. And the prior period item. What is a prior period item? An item pertaining to the previous year, getting recognized in the books of accounts now on account of a mistake in the previous year, then that is a prior period item. If an item of a previous year is got to know now, and now you are paying it, there may be some escalations what you should have paid last year. Let us say salaries were agreed to be paid at a particular percentage, and then after wage negotiation we'd say with retrospective effect from the last 2 years we have to pay more. Then that is not a prior period item. Although I'm paying 25% extra wages to the employees of the last 2 years, I will not consider it as a prior period item because it is not an item which I knew in the earlier years. It is not a mistake. It only got recognized now. So then it will not be a prior period item. A prior period item is an item of the previous year which was not recognized in the previous year by mistake. So if it is a mistake and that is what you are rectifying now, then it should be specifically told in the financial statement that it is a prior period item. And changes in accounting policy. So the rules, how you change the accounting policy is what is told in accounting standard 5. This standard also goes on to say that if an item is an extraordinary expenditure or an income or an exceptional item of expenditure or income, that shall be separately shown on the face of the profit and loss account. Next, accounting standard 6. Very interestingly, you may be shocked. People who have not who have not dealt with accounting standards may be shocked to see depreciation. There is no accounting standard. No, that is not like that. What happened is in the year 2016, there was a thorough amendment which happened in accounting standard 10 and a few other standards, primarily accounting standard 10, wherein they changed the name of the accounting standard from fixed asset. Accounting standard 10 was dealing with fixed asset. They changed it from fixed asset to property, plant and equipment. This standard today also deals with depreciation. So depreciation is now dealt with in accounting standard 10, and I jocularly keep telling this, that accounting standard 6 on depreciation has been fully depreciated. As a matter of fun there. So accounting standard 6 today, depreciation, the aspects of depreciation is dealt within accounting standard 10. Accounting standard 7 deals with construction contracts. What is construction contracts? This is who should follow construction contract. Not everybody who's doing construction should follow accounting standard 7. Only those contractors who are doing any construction, not necessarily dealing with construction of land and building. It should be construction of equipments also. If I'm making a ship or a huge aircraft which is spread over more than 1 year, construction contract standard has to be applied for revenue recognition. Accounting standard 7 tells the rules for recognizing revenue in the books of a contractor whose revenue is spread over for a single project for more than 12 months. And what is the rule of this particular standard? The fundamental rule of this construction contract is, although the contract could be spread between more than 1 year, accounting standard 7 says in the books of the contractor, you shall recognize revenue using the percentage of completion method. You cannot say, if the contract is taking 3 years, I will recognize the revenue and therefore the profit only at the end of 3 years. How will I know how much profit I made? I will come to know only after 3 years. So therefore, I will calculate the profit only at the end of 3 years. So that is not permitted. when you can either follow the completed contract method or the percentage of completion method from almost 2007 onward, or much earlier. Accounting Standard 7 goes on to say that you have to, every contractor must prepare his books of accounts using the Accounting Standard 7 for revenue recognition, and there the only method permitted is the percentage of completion method. Now, how do you work out the percentage of completion method and certain other do's and don'ts is told in Accounting Standard 7. Accounting Standard 8 earlier dealt with research and development. Again, I jocularly keep telling this. After much research and development, Accounting Standard 8 was removed and merged with Accounting Standard 26 dealing with the intangible assets. So Accounting Standard 8 R&D is now covered under Accounting Standard 26 on intangible assets. Accounting Standard 9 is a very important standard which is on revenue recognition. What is this revenue recognition? How do you recognize your revenues? Your revenues could come by way of sales, turnover. It could come by way of interest income. It could come by way of rental income. It could come by way of services income, like that. How do you recognize your revenue in your financial statements? Fundamentally, they have changed it into goods, services, and other heads of income. Now, for goods, Accounting Standard 9 says you shall recognize revenue only when you are transferring the risk and reward associated with the goods. If you have transferred the risk and reward with respect to the goods and are sure of realizing the value, you are not having any doubt with respect to its realization or its calculation, then you shall recognize revenue. Then there is a service contract. For services, how do you recognize revenue? So for services, let us say your services and my services, or for that matter, AMCs or whatever services that we are rendering, could be using either the completed contract method or the proportionate completion method. Other than for construction contracts, for services, you can still follow a completed contract method. Whereas you can also have an option of doing the proportionate completion method for services. Now, point number 3, for other incomes such as interest should be recognized on a time proportion basis. Advertisement income should be recognized only after the advertisement has been issued on behalf of the client. Like that, for other incomes, they have given the rules as to how we are going to recognize the revenue. Then Accounting Standard 10, property, plant, and equipment. Now, this is a very, very detailed standard, a property, plant, and equipment dealing with various aspects. Let me take you straight away to property, plant, and equipment. I would spend some time in explaining, because this is a new standard which came in from 2016. And although it is almost now 4 years now, I felt that I should explain this better. Earlier, it used to be called as fixed assets. Now it is called as property, plant, and equipment. And this standard also deals with depreciation on such property, plant, and equipment, just like intangible assets also deals with amortization. Depreciation is to tangible assets, amortization is to intangible assets. So depreciation on tangible assets is dealt within Accounting Standard 10. Amortization on intangible asset is dealt within Accounting Standard 26. So the revised name, the revised entire, what was a very small standard became a 91 paragraph standard from 2016-17 for companies, and for non-companies from 17-18. So this is a very detailed standard, almost in line with IFRS and Ind AS. Even in IFRS and Ind AS, there are 91 paragraphs. Even in Accounting Standard 10, it is 91 paragraph. Now, earlier definition of fixed assets means fixed assets are assets which are meant to be used by the entity. Now they change the definition in Accounting Standard 10. Property, plant, and equipment means tangible items held for use in production or supply of goods or services, for rentals to others, or for administrative purposes, and are expected to be used during more than a period of 12 months. Now, an item of fixed asset earlier could now not be qualified to be taken off as property, plant, and equipment. Maybe, let me tell you an example of a pen. And if I think that a pen Earlier, I had a doubt whether it should be taken as a consumable or as a fixed asset. And since it was meant for use, I had to take it as fixed asset. Now they said you cannot take an item as a fixed asset until you are sure that it will be used for a period of more than 12 months. Now here exactly, let me tell you that stores and spares used in the business, we had a big confusion as to where it should be taken. Should it be taken as inventories or should it be taken as fixed asset and now as property, plant and equipment? Earlier definition of stores and spares was very, very funny. It said that if the stores and spares are used with a particular asset, with only one particular asset, then it was a fixed asset. And if the stores and the spares were to be used with any asset in the company, then it was an inventory. A very confusing definition. Now in accounting standard 10 property, plant and equipment, they say if such a stores and spares are having a life of more than 12 months, then it should be treated as property, plant and equipment. Otherwise, it will be considered as inventory. Now, what is the difference if you call it as fixed assets and as inventory? If the rules of measurement, the rules of finally measuring the value in the balance sheet will change. If you are calling it as an inventory, the rule of cost or net realizable value, whichever is lower, will come into picture. Whereas if you are calling such stores and spares as a property, plant and equipment, you shall measure it at cost less depreciation, less impairment. So which means you will definitely, even if you have not used that particular item of stores and spares, because you put it as it could be an insurance spare. You have just kept it aside to use it if the main machines conks. But just because you have kept it as a spare for this machine, if this machine has a life of more than 12 months, you shall depreciate it even though you have not used it. The reason there being, it is capable of being put to use, so therefore it should be depreciated. In fact, another reason is the elapsation of time is also a reason why depreciation has to be charged. So that is a new definition. The deferred settlement, cost to exclude interest. Let us say if two companies, company A is buying a machine from me, company A is buying a machine from me worth 10 crores by paying 10 crores immediately, and company B is buying machinery from me and telling that they will pay me after 2 years. Therefore, I will not sell it to him at the same price as 10 crores, but I will be charging him 11 crores. Until the revision happened, company A would have accounted this machinery at 10 crores and company B would have accounted machinery at 11 crores. Now the revised property, plant and equipment definition says, the standard says, for deferred settlement, because I am paying this for a period of 2 years, there must be an inherent interest built in that particular cost. So therefore, the cost of the machine should be the cost if it is cash down, which is 10 crores. And the balance 1 crore what the company has paid shall be taken as an interest cost to be dealt with as told under accounting standard 16, not as per accounting standard 10. So cost to exclude interest if it is done on a deferred settlement basis. Componentization is made mandatory. What does this mean? Componentization is made mandatory means if I'm buying, let us say, a land and building, land and building costing 12 crores, I cannot take land and building as one head in the balance sheet. I will have to break land and building separately. What is the reason? Because building has a limited life, land has a perennial life. Not only that, within building, I will have to further break it down into civil works and interiors. Let us say I bought a land and building for 12 crores. Land cost was 2 crores. Building cost was 10 crores. Within the building cost, 9 crores is towards the civil cost and 1 crore is towards interiors. Because interiors has a lesser life as compared to the civil building, I will have to componentize the fixed asset acquisition under 3 different heads: land 2 crores, building civil works 9 crores, building interiors 1 crores, and depreciate it over the useful life of that particular asset. So land I will not depreciate because it has a perennial life. Building of 9 crores I will depreciate it over a period of 60 years. and the depreciation on buildings interiors, I will depreciate it over a period of 5 years only. If I have taken entire 12 crores and tried to depreciate it in 60 years, it will give me a wrong calculation altogether. After all, depreciation has a very important meaning of setting aside that much of profit for recouping or for repurchasing the fixed asset in future. So that particular purpose will not be served if you are aggregating all the assets. You will have to segregate that particular asset called as componentization and depreciate it accordingly. The fifth point is expense current repairs. Expense current repairs, no doubt. Whatever is the current repairs, I have to expense. But capitalize replacements. Earlier standard said, very interestingly, for capitalization, I had to capitalize. Let us say I had a hotel and one of the lift I had to replace. So the same hotel, I replaced the lift. The old lift, I gave it up and the new lift got into picture. The question was, should the new lift be taken as a capitalized cost or should it be expensed? Earlier situation said I had to capitalize replacement if and only if future benefits from it is beyond the previously assessed standard of performance. And since the lift which I replaced earlier also was 8-passenger lift and now also it is 8-passenger lift, there was no increase in the standard of performance. So therefore replacement were always debited to profit and loss account. Now property, plant and equipment standard says if the cost would meet the recognition criteria, that is the cost can be measured reliably and it is probable that future economic benefit will flow to the company. Recognition criteria means if the new asset is going to be there for is going to be used for more than a period of 12 months, then you shall capitalize the new asset. You will not debit it to your profit and loss account. So the cost of the new lift will be debited to the property, plant and equipment and taken as a balance sheet item. However, the cost of the old lift will be de-recognized, meaning you will be removing it from the fixed assets block. Whatever is the carrying value of that particular old lift will be removed from your block of asset and the new lift will be added to the cost. Major inspections, capitalize replacements and major inspection if it meets the criteria of property, plant and equipment. Not only replacements, even major inspections, especially in aircraft industries. People who are in the aircraft industries, they will know that once in 3 years, there has to be a major inspection and the inspection cost itself will be, whether or not they do the replacement, the inspection cost, the overhauling, the removing and replacing to find out if there is any major repair that has to be undergone, the inspection cost itself will be about 2.5 crores, 3 crores. So whether that cost has to be expensed or capitalized, they said major inspection which is done can also be capitalized. The next point we have already seen, machinery, spare parts, standby equipments and servicing equipments to be capitalized if it meets the criteria of property, plant and equipment. I already explained this. Point number 7, depreciation method chosen should be reasonable. I mean, although I told you that we have a return on value method or a straight line method or a unit of production method, you will have to justify why you have chosen a particular method. Earlier, this choice was left to me without me being questioned. Now, if somebody asks the ROC or somebody asks me, why did I choose straight line method? I should be in a position to explain the reason. Reassessment of depreciation method, at least at each year end. Then I will have to see whether I am following straight line method, whether it is the right method or should I actually go in for a return on value method. The difference between straight line method and return on value method primarily is straight line method assumes that the assets are used on a similar manner or a similar pattern between the years. Under the return on value method, it is presumed that the usage of the machine will be more at the beginning, hence the depreciation charge will be more. Change in depreciation method from straight line to return on value or vice versa is considered as a change in accounting estimate, giving the effect prospectively, unlike in accounting standard 10 originally, where it was considered as a change in accounting policy requiring retrospective effect. Then point number 8, review of useful life and residual value at least at the end of each year end. Now, depreciation, I will say that the value of the building's life is for 60 years. But if something happens in between, I will have to change the useful life. I have to review the useful life and change it at every year end. Not only the useful life, including the residual value, if any. How do I measure the property, plant and equipment after recognition? At the time of recognition, whatever I have paid for, I will recognize. But after recognition, I will use the principle of cost or revaluation model. I can choose any one of the model, cost or revaluation model, and I have to follow it consistently. I will have to follow it consistently. That means cost less depreciation. Revaluation model means I will have to continue to revalue it periodically. If the the fluctuation in the value of the asset is very high, then I have to revalue it every year. Otherwise, I will have to revalue it periodically, not more than 5 years interval. So that is the revaluation model. I can follow any one of the model for measuring after recognition. Incremental depreciation on revaluation. That means once I revalue, let us say a building which was costing 10 crores, I will revalue it to 50 crores. Then the depreciation in future should be on 50 crores. Naturally, earlier also we used to do it on 50 crores. But the debit of that particular depreciation, including the higher value, will be entirely to the profit and loss account and not to the revaluation reserve account. So that is a change which has happened after Accounting Standard 10 property, plant and equipment came into picture. Investment property. When properties can be of three types. It can be inventory property meant for sale, property, plant and equipment meant for use, or it could be an investment property, not for sale, not for use, which means it is for capital appreciation or for earning rentals. If then in that context it becomes an investment property, for which we'll have to use only the cost model and not the revaluation model. Then they have talked about unit of measure. Very interesting concept they have introduced. What is this unit of measure? Earlier we had a doubt. Suppose I am setting up a big factory of 100 crores and outside my factory, my factory is in actually a jungle, and from the highway I have to draw the road to come to my factory. Now this road I have spent 1 crore. And to draw the electrical line from the substation, I only had to spend the money. Let us say I spent 2 crores to bring the line to my factory. And let us say next door some other factory comes, he just has to draw the road from my factory to his road. The point I'm trying to say is this particular road which I put up, this particular line, I can use or anybody else can use. The question that came out is 100 crores I have spent, no problem, that is my fixed asset, my property, plant and equipment. This 1 crore of road and 2 crores of substation which I put it outside my factory, anybody else can use. So can I call it as my asset? This 1 crore and 2 crore, can I call it as my asset? Earlier definition of an asset means asset is a resource controlled by the entity. And a resource control means it should be positive control and negative control. Positive control means I should be able to use it. Negative control means I should stop you from using it. If you are trespassing, then I should say that you cannot trespass. In my factory building, I can put that measure. But outside my factory, I have put the road. That means I have put it on the government. I have land by taking specific permission and incur the cost of laying a tar and drawing a line. Now this 3 crores of cost, there was a confusion whether I can take it as my asset in my balance sheet. Now, by virtue of new Accounting Standard 10, you can take it as your cost, but earlier it could not have been taken. So that is a change which has happened. Exchange of assets, they have given a formula how it has to be calculated. In fact, this standard also talks about agricultural accounting, and it goes on talking about decommissioning, restoration, and similar liability. Let us say I am in the field of oil rigs or mining or whatever, and I have got this land for 25 years. I do a coal mining, and the government at the end of the stage says, after you mine, you have to level the field. You'll have to level the field and give it back to me in the manner I have given it to you. Something like that. Or the landlord has given me a building, and has given me a land, and he tells me, you construct the building. After 20 years, you must demolish the building or remove the interiors inside the building and give it to me. The cost of the decommissioning, restoration, and similar liabilities will have to be estimated at the time of the beginning itself and not at the time of incurring after 20 years. I will have to estimate how much cost I'll incur, not only for construction of the building, but for decommissioning, removing the interiors, restoration, that means leveling the land, and any other similar expenditure I will have to estimate. Let us say the cost of construction is 10 crores. Cost of decommissioning restoration is 2 crores at the end of 10-20 years. I will have to bring it out to its net present value. 2 crores at the end of 10-20 years means maybe 20 lakhs now. And along with 10 crores, I have to add 20 lakhs and depreciate. And on this 20 lakhs, I have to build up a finance cost over a period of next 20 years, such that 2 crores is available to me at the end of 20 years to meet this particular expenditure. So they have told like this. So elaborate disclosures are also required. So that was a very detailed discussion on accounting standard 10. So let me now move to accounting standard 11, which deals with effects of changes in forex rates. I mean, in small and medium companies, they may not have too much of a disclosure, but what it says is, this particular standard, accounting standard 11 says, is how do you account for forex fluctuations, is what is told in accounting standard 11. You will have to recognize the item at the time when it is transacted at the rate. Let us say I bought an item for $1 when it is 75 rupees. So I will record it in my books as purchases to. I mean, if it is paid means there is no problem. Purchases to bank 75 rupees, gone, finished. But the issue deals with forex fluctuation, which means I have to still pay it to him. I will have to still pay it to him. Then the standard says, if you have to pay it to him after, let us say I bought it in the month of July and I'm going to pay him after 1 year, next July, then I will say it as purchases. I cannot book it as $1. I have to convert $1 into rupee terms, 75 rupees, to George Bush account, 75 rupees. Now, when I finally paid to him in July of 2022, this 75 would have become 85. Now, how do I recognize the 75 and 85? The 10 rupees extra, how do I measure, is what is told in accounting standard 11. First of all, the standard says, if there is a balance sheet prepared in between, from the time you entered the transaction till you paid him, there is a balance sheet. Yes, 31/3/2022, I have to prepare a balance sheet. How do I measure the difference between the balance sheet date value and the purchase date? On the balance sheet date value, let us say it became 75, became 80 rupees. I have to take 5 rupees as debit, forex fluctuation 5 rupees, to George Bush account 5 rupees, such that George Bush account will become 80 rupees. How do I this debit should be debited to profit and loss account. Similarly, at the time of settlement, forex fluctuation, I will take another 5 rupees to George Bush account, 5 rupees, and settle it. So how do I treat this forex? Should it be debited to profit and loss account? Should it be debited to the asset account if it is in relation to an asset account? That rules is what is told in accounting standard 11. Accounting standard 12 deals with government grants. Government grants could be either by way of revenue grants or for capital grants. Capital grants could be by virtue of in relation to specific assets or general. If it is revenue grants, I credit it to my profit and loss account. If it is in relation to capital grants and in relation to a specific asset, then I deduct that grant from the value of the asset. When and only that net value, I will take it as property, plant, and equipment. If it is a general grant, then I am allowed to keep it under reserves and surplus over a period of time. Now, talking about accounting standard 13, accounting for investments. Now, this particular standard goes on to say, how do you measure investments? Investments could be of two types. It could be current investments or long-term investments. Current investments are to be measured using cost or fair value, whichever is lower. Whereas long-term investments are always carried at cost unless there is a reason, unless there is a reduction in the value of the investment for reasons other than temporary. So, I mean, let us say I bought an investment on a long-term basis at 100 rupees per share. If there are, I will always carry it at 100 rupees in my books per share. If the value goes up from 8, when it can go up 95, 105, 102, that means these are all temporary fluctuations. But somewhere over a period of time, if it has fixed around 60 rupees, if it has gone up to 160, then I don't measure that. I'll keep it at 100 rupees only. But if the value has fallen down to, let us say, 60 rupees, and then it is moving around 60 rupees and it is never coming to 100 rupees, then I will say that there is a decline in the value of the investment, which is for reasons other than temporary. For a long period, it is being around 60 rupees. Then 40 rupees, I have to bring down the value of investment as loss in carrying value of investment. Accounting standard 14 deals with amalgamations. Only when there are mergers and acquisitions, this standard is used, hardly applicable to SMCs. Accounting standard 15 is employee benefits. What is employee benefit? Employee benefit could be payments to my employees. In fact, benefits to the employees. For the entity, it is a cost. What I will be paying in the next 12 months is called short-term employee benefits. What I pay him from next 12 months till he retires is called other long-term employee benefits. Other long-term employee benefits. Then we have got at the time of termination is called termination benefit, and whatever is paid to the employee after his employment is called post-employment benefits. So there are 4 types of employee benefits: short-term, other long-term, termination, and post-employment benefit. 4 types. Now, within these 4 types, we further segregate that into defined contribution plan and defined benefit plan. Now, if I'm going to tell him, if I'm going to give for short-term employee benefit is very simple. Whatever I'm going to pay him next 12 months, which whatever I'm going to pay him, I debit it and close it to the profit and loss account. But for long-term employee benefit, which includes the other 3, that is the other long-term or termination or post-employment benefit, what I do is, I will have to, because it is to be calculated, please understand, although I'm paying the employee at the time of his retirement, accounting standard 15 says you shall account such benefits periodically during his employment. There may be an employee to whom I am paying post-employment benefit, but the debit to the profit and loss account should not be at the time of payment, in which case it would be cash method of accounting. But under the accrual method of accounting, you should build it at the time when he is in employment. Now, should you build it equally, or should you build it more at the beginning and less at the end, or should you build it less at the beginning and more at the end? The answer is given in accounting standard 15 that you shall follow the project unit credit method. That means small in the beginning and more in the end, because the benefit derived from an employee at the time of his retirement is the highest. When he joins, it will be the lowest. So therefore, it cannot be equal. Let me just tell you that I have to pay to an employee a gratuity benefit of 10 lakhs. 10 lakhs. And he has got 10 years balance working life, balance employment life. I will not debit 1 lakh every month, nor will I debit higher at the beginning and lower at the end. What I will be doing is 10 lakhs, I will bring it down. I will find out what is the fair value that I should invest today, such that I have to get 10 lakhs at the end of, I will equate it. What I will do is I will equate it 1 lakh every year. But within 1 lakh, I don't have to put in 1 lakh today to get 1 lakh at the end of 10 years. How much should I put in today? Maybe I have to put in 25 lakhs. So 25 lakhs will be debited as employee cost. And next year this 1 lakh means it will be 35. It will be going on building up. Along with the employee benefit, I will also build up a finance cost on this 25 for year 1. I will build up the interest for year 2. Year 1 and year 2, I will build up the interest on the accumulated fund of 25 and 35 in year 3. So along with the employee benefit and the interest element, it becomes 10 lakhs at the end of. So in the beginning, it will be only 25. In the last year, maybe it can be 2 lakhs or 2.5 lakhs, such that if you sum total it up for that particular employee, it will be 10 lakhs. So all these calculations will be done by an actuary, especially with respect to defined benefit plans. There is something called the defined contribution plan, like a provident fund. What we do is, although the employee has to be paid at the end of, let us say, 5 or 10 years, we will be giving it to an external agency. It is his risk to actually pay to that particular employee. If the risk of the plan is on the person who takes over this particular plan, like a PF agency, then it is called as a defined contribution plan. I contribute it and I forget it. He takes the load. In that context, I just whatever I pay will have to be debited. But in the case of a defined benefit plan, I have to take the help of an actuary to measure it. Now, why did I mark it as a green shade with a blue is this is also applicable to a small and medium company, but there are relaxations available to a small and medium company. Next, borrowing cost. What is this borrowing cost? This talks about how do you account for interest and other costs of borrowing. In simple terms, the interest and other costs associated with borrowings have to be expensed, unless it is in relation to a qualifying asset, in which case till the assets are put to use, it can be capitalized. the interest can be added to the cost of the asset if such an asset happens to be a qualifying asset. What is a qualifying asset? A qualifying asset is an asset which takes substantial period of time for its completion, normally for 12 months. Then point number 7, accounting standard 17 is on segment reporting. Accounting standard 3 and 17 not applicable to SMCs, small and medium companies. Segment reporting means reporting of the balance sheet items and the profit and loss account items by segments, by business segments or by geographical segments. The rules of segmenting it is what is told in accounting standard 17, which I'm not talking today because it is not applicable to SMCs. Accounting standard 18 deals with related party disclosures. It deals with related party disclosures, which means I will have to find out who are all my related parties. It could be my holding company, subsidiary company, joint venture companies, or with my owners, or with my key managerial personnel, or the relatives of my owners and the key managerial personnel, or with an entity who is exercising significant influence on me. So they all become the related parties for the entity. And if there are any transactions between the entity and such related parties, the transactions must be disclosed. One more point to be noted in accounting standard 18 is the transaction between holding companies and subsidiary companies. Even if it is not there, that the relationship between holding company and subsidiary companies must be disclosed in the related party disclosures. What I mean is, the holding company should give out a list of who are all my subsidiary companies, and the subsidiary company should give a list of who is my holding company, whether or not there are transactions. But in all cases, wherever there are transactions, those transactions must be disclosed according to a format which is given in accounting standard 18. Accounting standard 19 deals with leases. There are relaxations available to SMCs. Generally, SMCs do not go in for leases, but leases could be of two types: operating lease and financial lease. Operating lease means a Shamiana supplier or a computer, normal, which we take it on rent, and even a building I could have taken it on lease. That means where the risk and reward associated with the asset will be with the lessor only. Then I pay lease rentals, and that lease rental should be debited to profit and loss account. But there is another type of lease called the financial lease. In the case of a finance lease, the agreement is such that it will be saying that it is on lease and lease, but the agreement is such that the lessor actually transfers the risk and reward to the user. The user cannot, after a point in time, tell the lessor, you please take it back. Similarly, the lessor cannot demand the item to be returned if the terms of the contract is complied with. So in substance, a finance lease is actually like a loan transaction. A finance lease must be recorded in the books of the lessor and the lessee like a loan. So this is exactly what happens. It is a case of substance over form. In substance, it is actually the lessor has actually, although the legal owner is the lessor, the real owner is the lessee. So the real owner should account that particular asset. So that is the rules told in accounting standard 19. Accounting standard 20 deals with how to calculate earning per share. Earning per share is very simple. Total earnings after interest and taxes available to equity shares divided by total number of outstanding equity shares. There are various methods. There are calculations how it should be done in the case of a loss. There is something called the diluted earning per share. Diluted earning per share, one is the basic earning per share, the other one is the diluted earning per share. A diluted earning per share goes on to project what will be the reduction of an earning per share if the potential equity shares already available in the balance sheet or contracted becomes equity shares. Like, for example, a convertible debenture or a convertible preference shares, a compulsory convertible preference share, if it is converted, what will be the impact of that conversion on the earning per share is what a diluted earning per share is. So in the case of even a small and medium company, earning per share basic has to be told, diluted earning per share need not be shown. Accounting standard 21, 23, 27 all deals with consolidation. This is normally in a small and medium company. I already told, small and medium company cannot have a holding company or a subsidiary company. Even if that is there, that is not that should not be a non-SMC in that sense. So therefore, consolidation Accounting Standard 23 and 27 will not be applicable to SMC, which I am not talking today. Accounting Standard 22 is very interesting. Accounting Standard 22 is very interesting. It deals with how do I measure my provision for current taxes and provision for deferred taxes. Now, this is a very major standard, and I will stop after talking about a couple of standards and ask it for questions. I may not be able to get into the issues in the time restraint, but I can always come back and have a second session to talk about the issues on various standards. Accounting for taxes on income. Provision for current taxes means I do prepare my computation of income. In the computation of income, I will be finding out what is my taxes that I have to pay for the year. That is the provision for current taxes. There is a new concept which came in 2000 itself, not new in that sense. For the last 21 years, it is there. That is called the provision for deferred taxes. What is the deferred taxes? Now, from the accounting income, I arrive at the total income by adding and deducting certain items. That is a computation of income which all of us are aware of. In the computation of income, if I added certain items which are going to be deducted in future, then that addition is called as a timing difference. But if I've added certain items which I will never get as a deduction in future, like for example, penalties, if I'm paying some penalties, it will never be allowed to be deducted. But if there are certain additions like I did not make the TDS this year, therefore it will be added. But next year on the same amount, if I make the TDS, it will be allowed. Then it is called as a timing difference. Similarly, there could be certain deductions which could get added in future. So if there is an addition by virtue of which there will be a deduction in future, I will create a deferred tax asset. And if there is a deduction now, which will reduce my taxes, reduce my current taxes, but will go to add to my taxes in future, then that is called as a deferred tax liability. That in short is deferred tax assets and deferred tax liability. If I am given 3 hours, then I will explain all these standards in detail. Accounting Standard 23, yes, investments in associates applicable only for consolidation. Accounting Standard 24 is on discontinuing operations. If I have to discontinue certain operations in future, the impact of that future discontinuation has to be disclosed right from now onwards. That is what is told in Accounting Standard 24. Accounting Standard 25 tells me the rules for preparing quarterly financial statements. You must have seen listed companies which give interim financial statements every 3 months. Now, how do I prepare the 3 monthly financial statement? There are rules of following whether it is a integral approach or a discrete approach. Should the 3 months be considered as a part of 1 year, or 3 months should be considered as 1 year itself? So if you are considering 3 months as 1 year itself, that is called as a discrete approach. But if you are considering 3 months as a part of 1 year, then it is an integral approach. So the rules of preparing interim financial reportings is what is told in AS25, not applicable to SMCs, because SMCs generally don't prepare quarterly financial reporting for the purpose of outsiders. Maybe MIS it is prepared for insiders, that is not certified, then there is no problem. Accounting Standard 26 tells how the intangible assets. What are intangible assets? What is the difference between an intangible asset and a property, plant, and equipment? Property, plant, and equipments are tangible. Intangible assets means they don't have physical presence. They don't have physical presence. It could be brand equity. It could be goodwill. It could be various, research and development cost. All this, how do I measure? The rules of that is what is told in intangible assets. And once I recognize it as an intangible asset, I have to systematically write it off as an amortization in the useful life of that particular asset. AS27 I already discussed. AS28 deals with impairments. What is an impairment? Impairment means it is more than depreciation. When an asset, you write off the asset value systematically in the useful life of the asset, then it is called depreciation. For example, I bought a laptop for 1 lakh. Then it has got a life of 3 years. That means every year I have to write it off 30,000. If I'm following straight line method, 33.33 thousands, I write it off. But at the end of 1 year, this laptop fell down, and there were certain major damages to that particular laptop, because of which the life of the asset got reduced from 3 years to let us say 1.5 years. Then the depreciation, I cannot charge 33,000 like I used to do earlier. I will have to charge a higher reduction in the value. That higher reduction, if it is a systematic write-off, it is called depreciation. If it is an unsystematic write-off because of external reason or internal reason, the reasons for impairment could be many. It could be an outside value. The value of the laptop, what I purchased for 1 lakh is available now at 60,000 rupees. Then I will have to bring down this laptop value also to 60,000 rupees. There are certain rules which are told, either based on the net real, and basically I have to compare the carrying value of the asset with the net recoverable value of that particular asset. Carrying value is the balance sheet value. Net recoverable value is the higher of value in use or net selling price. So if there is a reason, then I will measure impairment using certain principles. That is what is told in Accounting Standard 28. Not very important for small and medium companies. Provisions, contingent liabilities, and contingent assets. What is a provision? Provision is to be distinguished with accrual. I will follow accrual method. In an accrual method, provision for audit fees, provision for rentals will always be prepared. That is accrual method. In a provisions, they say if there is a liability which is certain, but the amount is not certain. The amount is not certain. I mean, I have to use substantial degree of estimation to work out that provision. Say provision for warranties, provisions for tax liabilities. Then nobody comes and gives me a bill for that, or there is no contract for that. But I have to estimate that particular liability and provide for that in my books of accounts. Then that is told in, if it is a liability which is existing on the balance sheet date, but the amount is not known to me, that is to be used using the system as told in Accounting Standard 29. Contingent liability means a liability is not certain. There is a possibility of its occurrence, but the chances are very less than 50%. The liability itself is not certain. Then it becomes a disclosure item not to be recognized in the books of accounts. A contingent asset is an example of lottery ticket. I have purchased a lot. If it comes, it may come, it may not come. That need not be disclosed also. So that is, in short, the list of accounting standards as applicable to SMCs. So in the given time, I will not be able to get into the details today because it's already 7:30, but I would like to open it up for questions. Take as many questions as possible. But before I close my session at 7:30, I mean, I was supposed to close my session at 7:30, so it's already 7:29. But what I liked about one statement, man needs his difficulties because they are necessary to enjoy success. This was the statement which I picked up from the CMA journal this time. If you look into the CMA journal this time from the president's speech, this is what I liked it. APJ Abdul Kalam's quote has been quoted by our President Basu. Man needs his difficulties because they are necessary to enjoy success. And then I linked it up by saying behind every successful business decision, there is always a CMA. Thank you, Murthy Garu, for giving me this wonderful opportunity of giving out my thought process on accounting standards as applicable to MSMEs. But then I am available for any questions.
Thank you, Guru Raj Acharya sir. It was a fantastic, I will tell you why it was fantastic, because you sum up only in one slide. You are so thoroughly prepared that you sum up everything in one slide, those 29 standards in one slide, and the way you have gone right from the first standard till the last standard, it was phenomenal. Thank you so much on behalf of all our members, students, whoever has attended today's session. And of course, this has been done a live telecast on the YouTube also. So henceforth also, anybody who wants to refer, it can be referred by them. So while having this session, there are a few questions which has come up. So Santosh Bisht has asked this question. My question is on AS2, a company spending significant amount for bulk purchase of incentive items and cost charged to profit and loss account. Consumption is over more than one financial year. It appears wrong practice to me. Your advice?
No, see, whatever has been purchased, it could have been bulk purchased. You cannot consume it and debit that particular item as whatever purchases cannot be shown as consumption. Purchases is not equal to consumption. All of us know that fundamental rule. We will have to work out what is the closing stock and accordingly calculate the closing stock of that particular inventory. I mean, I have seen in SAPs, especially in SAPs, they have a method of whatever is purchased is shown as consumption. And at the year end, they have to actually work out, they have to physically identify how much of stocks are remaining with them. And that stocks, they have to use the principles of AS2 and show it as a closing stock. Of course, opening stock is already there. Opening stock is nothing but a carry forward of the closing stock of the last year. And purchases of the current year, if it is debited, then I will find out what is the closing stock using the principles of AS2 and measure the consumption. After all, opening stock plus purchases minus closing stock is the consumption. So you cannot put the purchase itself as consumption. Rather, you'll have to work out the closing stock using the principles of AS2. Let me just tell you, there is a principle of closing stock of services. There is something called closing stock of services. This may be very interesting. Let us say I am following, I told you for services, you can follow either the completed contract method or you can follow the proportionate completion method. If what is meant by proportionate completion method, if I have got an order, for installation or for AMC, I have got an order for 2 years period for 2 crores, and I have just started 6 months back. That particular 6 months back, whatever, 50 lakhs is the 2 crores for 2 years means 50 lakhs for 6 months. At the end of 6 months, there is a 31st of March. I started it on 1st of September. By 31st of March, I have completed 6 months. So I will take to the credit of my profit and loss account 50 lakhs, and then whatever cost, let us say in 6 months I have incurred 30 lakhs as my cost. I will debit 30 lakhs as my cost and 60 lakhs as 50 lakhs as my revenue. So that is a case of proportionate completion method. If I'm following completed contract method, you know what happens? I debit to my profit and loss account 30 lakhs for 6 months. My revenue will be nil because I am saying entire revenue will be recognized after 2 years. Okay. But to bring about the matching principle, I will have to nullify the debit of 30 lakhs by bringing in a closing stock of inventory. Closing stock of inventory of 30 lakhs. Then only I will be measuring. Otherwise, entire 30 lakhs will look like I have built it as an expenditure. So when I'm following the completed contract method, the normal expenditure incurred on the project should be shown as closing stock of services. Yes, sir. Next question.
Yeah. So next question is, Mr. Ranganathan has asked this question. In AS adoption, the focus is on replacing cost by fair value. There is a call to keep historical cost and report fair value against the same.
Yes.
Don't you feel this is a serious lacuna in Ind AS?
Sir, Ind AS is very, very scientific. In AS, it is so scientific that sometimes I feel that Ind AS is actually prepared by engineers more than by the accountants. So scientific it is. Okay. So having said that, Ind AS may look like illogical and too difficult to calculate from an accountant's perspective, but Ind AS is a very, very scientific method of calculating. For example, let me tell you, before I get into Ranganathan's question, I will tell you how Ind AS mechanism works so that everybody understands, and then we come to Ranganathan's question. Now, in Ind AS, for example, I give you a deposit of normal accounting. How it happens, I will tell you. 1 crore I have given you as deposit. You are the landlord, I am the tenant, and to take your building, I have given 1 crore as the deposit, and I pay you, let us say, 10 lakhs as rent every year. This is for 5 years. For 5 years, I will give you 10 lakhs every year, and I have given you 1 crore deposit now, and after 5 years, you will return my 1 crore. In accounting entry, what we pass, very simple. I will show 1 crore as deposit to Mr. Thatte, and you will show 1 crore as security deposit due to Mr. Acharya. And when I pay 10 lakh rupees as rent, I will debit 10 lakh rupees as rent, and you will take 10 lakh rupees as rental income. This is accounting standards. Simple accounting. You know in India how it works? It doesn't work like that. They bring in the time value of money. 10 lakhs, no problem. 10 lakhs, I will debit and you will credit, no problem. This 1 crore, when I paid 1 crore to you, I could have bought 10,000 square feet of land in a particular village. Let us say, I'm just putting not in Bangalore or Bombay. Okay. I could have bought 10,000 square feet of land for 1 crore. After 5 years, when you return to me, 1 crore, sir, I can buy with that 1 crore only 5,000 square feet of land. Do you see that?
Yes, yes.
So that means the 1 crore which I gave you, you are not returning 1 crore in same value. So that is what is fair value. I will have to now, please understand, I will have to now that 50 lakhs there is a reduction, right? Because 50% is gone. 1 crore मैं आपको जो दिया था, जब आप वापस दे रहे तो रुपी वैल्यू में 1 crore है, मगर उसका इंट्रिंसिक वैल्यू जो है वो 50 लाख ही हम मेरे को आप वापस दे रहे. तो along with this 10 lakhs rent, I have paid you additional 50 lakh rupees as rent, which has to be debited to my profit and loss account as rent for the next 5 years. But then in rupee value, you are actually returning me 50 lakh.
1 crore.
1 crore. So I have to, if I, now what I do is first year I will debit 10 lakh rupees, 10, first agreed value. Then in this 50 lakhs, I will again debit on equated basis another 10 lakhs as rental. Then I will say, this rental I did not pay you. Now you will give me interest on this 10 lakhs. So the differential hai, my interest accounting karke, then I will again build it up to 1 crore. So in my first year, I will show I have paid Mr. Tatte only 50 lakhs and the balance 50 lakhs as equalization levy, and there is a way in which it is calculated. So this entire concept of जो मैं 1 crore दिया मैं मेरे को 50 लाख का equivalent वापस दिए, that is actually built up very beautifully. I mean, you may say, Baba, 50 lakhs का आप unnecessary debit भरा रहे हैं and 50 lakhs का unnecessary credit as interest income भरा रहे हैं for a period of 5 years. What is the great bloody thing that you did, if I may use some unparliamentary word, because this is the words that come out from, what is that you are confusing the account? In 50 lakhs you are debited as extra rent, 50 lakhs you are credited as extra interest income. Now please think of a listed company. Please think of a listed company where men may come and men may go. So between the years it has a differential. Over the period of time it doesn't have a differential. So much of scientific thing is built in Ind AS. Some may feel that it is very complicated. Therefore, it is for the moment made applicable only to complicated companies like large companies.
So, yes. Unless it is complicated, who will come to you and me for advice?
Ease of, I keep telling this on the same thing. Ease of doing business ज़्यादा हो गया तो हमारा शटर बंद करना पड़ेगा.
Correct.
Thanks to the government for making it as complicated. Yes, sir.
No, I was happy for a while. You said you pay me 1 crore rupees, 50 lakh rupees. I am waiting for that something to happen. However, in your example which you had given, sir, about building up a factory in the forest and wherein you have paid 2 crore rupees for a road and 1 crore rupees for the electricity equipment. So therein, if any other factory comes, I will not show that asset into my books of accounts because that belongs to the government. I will be showing that as an expenditure.
Correct.
So at that point in time, suppose second, third, fourth, fifth, and later on a big MIDC comes to that area, then what will happen to my expenses which I have done?
See, what they have told in Accounting Standard 10 is, forget about who you others are able to enjoy that. But you are not worried about what others are enjoying. You are initially, you could not have put up that factory but for that particular expenditure. So what they said is, project does not mean your own project. They said the unit of measure is to be seen in a larger frame of mind. Your entire 100 crores would prove to be ruthless, fruitless waste. But for the 3 crores, But by incurring the 3 crores, you are able to enjoy the benefit of 100 crores. So therefore, 103 crores is your cost of the project now. You take it like that. Initially in Accounting Standard 10, the matter came up before the expert advisory committee of the institute, and there they said, since you are not controlling that particular asset, it has to be written off. It has to, because it is not your asset. You are not controlling that. So they were right in their terms, but then they were right in letter. You please understand, they are right in letter. Think from the point of view of the promoter. अगर उसका point of view से आप देखेंगे ना, तो ये 3 crore आप बिना कुछ काम किए, if you say that it should be debited to profit and loss account, उसको कितना दर्द होगा? और वो ये 3 crore जो लगाया है, वो खाम नहीं लगाया है, वो 100 crores का benefit लेने के लिए he has taken that particular cost. So for him, you have to have a larger vision than an accountant's smaller vision. So that larger vision is now made available through IFRS, Ind AS, and introduced in accounting standards.
Correct. So that is how the leaders also work. I'm very thankful to our president, our Murthy sir, that as a leader, they have put up some path today by spending that 3 crore rupees. So the path which they have set up today, tomorrow n number of people will come and continue with their path, but their efforts will be recognized forever, the path which they have put up to all of us. So thank you so much, Guru Raj sir, for all your efforts. And all the questions you have answered very nicely, and everything which you have put up to us, it's to be remembered for all of us. So back to you, Murthy sir, for your comments.
Just to supplement the argument of Mr. Guru Raj, suppose I take a bank loan, I pay 20 years. After 20 years, the last installments 15, 16, 17, 18, 19 are really useless for the bankers from the angle of value of the money. Last installments, what I pay, definitely are money-wise, they are valueless for the bank, though they see the money only technically for the purpose of recording or accounting. Entire money, whatever they get is really, sometimes it may be minus income also.
Yes, sir. I mean, that's what they say, no? Today, when you keep money in a bank at 5% and the inflation is 7%, actually, you are getting a negative income from the bank. Especially 5%, you are paying taxes of 30%, means 3.5% you get. Then a 3.5% as against 7% inflation, better not to keep. But the point is, if you keep it and lose it, if you keep it in a high interest place and you lose that, then bank is better, in that sense.
So days are not far away where banks will charge you for putting the deposit. Instead of giving interest, they will say that for this 1 year, we will charge you 1%.
This is what is happening in Japan. In Japan, it is happening like that.
Yes, correct.
We'll be charging you rentals for keeping money with us.
Correct. So those days are not far away. We have to get adjusted and accept to those things also.
So thank you, Mr. Guru Raj. Sorry, we have given very less time to you. I know you have covered 29 standards in less than 1 hour. But definitely we understand the problem of you being a knowledgeable person could not dwell upon anything. You touched only the crux of the standard and proceed further. We will definitely keep this in mind, and me and my colleague will definitely chalk out with the prior discussion with you. We will have at least, even if you tell 2 or 3 standards, let them be fully understood by the. Thank you, Mr. Guru Raj. Thank you very much.
Thank you so much, sir. Thank you so much.
Thank you, madam.
Now, Madam Vibhu, madam.
Thank you, sir. I wish to place a formal word of thanks to our eminent speaker, CMA Guru Raj Acharya, sir. So he has very well covered the issues relating to the accounting standard for the small and medium companies. He has thrown light on the, starting from the accounting standard as substance and form. Sir has covered the accounting standards rule 2021, which has recently been launched. So very nice thorough coverage of the topic. We look forward to various further presentations and coverage of the topic by our eminent speaker. Further, I would like to thank our Vice President, Sir CMA P. Raju Iyer, sir, for gracing the occasion and guiding the various committees in various aspects of their works. Further, I would like to thank CMA AVSN Murthy, sir, the Chairman of the Regional Council and Chapter Coordination Committee, and CMA Ashish P. Thate, sir, the Chairman of the Corporate Law Committee, for conceptualizing this program and jointly organizing this program for the benefit of the members, professionals, and the students at large. Also, I would like to place on record the thanks to the officials of the Institute, CMA Arup Bakchi, sir, the Secretary of the Committee, Dr. Sumita Chakrabarti, for creating this program, facilitating the program, our IT team, and last but not the least, I would like to place a vote of thanks to all the participants attending this event. Thank you so much.
We thank you.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड़ उत्कल बंगा विंध्य हिमालय हिमाचल यमुना गंगा उच्चल जलधितरंगा तव शुभ नामे जागे तव शुभ आशीष मागे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे